Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. A presentation from Girik Capital got me thinking into how I should construct today's talking point. The presentation focused a fair bit on what you can learn from history, both immediate and the recent history, to try and figure out what quadrants should you be present on when it comes to themes, when it comes to maybe asset classes as well. Um, Whenever the next up move has to start. And I think in today's conversation on Talking Point with the two men who join me, we'll be talking about these very points. So, of course, the macro about whether the rate hike or pause and what's the likely scenario over the course of 2023 and how would it impact investments in equities, which are the stocks or themes which can outperform, as most experts believe that 2023 could be a year of largely flattish returns. We'll try and ask them about what are the sectors that could lead the next leg of the bull market beyond 2023 as well. As share of UV sales see an uptick, can the space outperform in 2023? More importantly, can autos as a theme do really well in what might turn out to be a flattish year? And of course, advice for retail investor to navigate through mixed cues. The two gentlemen run Girik Capital. They are both co-founders and fund managers. And Charandeep and Varun join me on the show today. Gentlemen, both of you, thank you so much for joining in. Really good having you today.
Thank you.
Thank you. Thank you for having us.
The pleasure is ours. So, I'll start off with the broad macro. I don't know how much of importance do you usually give to what the Fed and the RBI and interest rates would do, but presuming that it is of vital importance now, more vital importance now than probably it's ever been, how are you looking at this particular point of reference when it comes to deciding your equity allocation? Either of you can start.
One quote from Peter Lynch comes to mind. I think that crossed Varun's mind as well. If you spend more than 7 minutes a week on macro, you already wasted 7 minutes. So we we are believers in that, and we believe that macro is very hard to predict. It's a very difficult game. It's too far up in the sky to determine directly the outcomes of your stock. So we like to focus much more on earnings progression and earnings growth and making sure we buy stuff right at the right price.
So, how did this earnings season, or maybe the last two or three earnings season, turn out for you, Charandeep? I mean, because quarter three we saw maybe a small miss, if you will, but when I look at the aggregate earnings upgrades and downgrades and the eventual earnings for FY23 or maybe even FY24, there aren't too many changes that have happened. So, have the last two or three earnings season changed your outlook on the overall earnings and specific themes materially, or have they largely remained the same?
It's a good question, Neeraj. What we like to look at is where you're getting outsized earnings progression and earnings acceleration. Now, there have been no nasty surprises as such. India was expected to grow as a headline. The Nifty earnings was expected to grow, and they have been growing largely in line, like you said. You have another couple of years, 2-3 years of good earnings visibility in India. Now, the point is that, how much of this is priced in. So that's the price aspect or the valuation aspect that we spoke about. We have to essentially do better than the overall earnings growth. We need to find sectors and stocks that are new, something that can add lots of value to investor portfolio above the expected rate of market return. So, that's our entire focus, and we're quite pleased with what we are seeing in the sectors that we like and where we think that there is good headroom for growth and surprise in the coming decade. We think there's lots of newness emerging in the market, and I think the market will hopefully come to realize and value this.
Interesting. Varun, can I ask you to marry this thesis with a really interesting piece that is often spoken about, but you guys have put it into good perspective in the presentation that you shared with us, which is how leaders of the preceding moves don't quite turn out to be leaders or outperformers in the next one. So now, for start off with telling us whether you believe we are at the start of a new bull run, or is it unpredictable right now, and then marry that with what has done well about versus what could do well with the earnings growth outlook that you guys have for the themes that you track.
Sure. No, I think this is we really believe in this point that Every bull market, uh, starts with new leaders, and new leaders lead new bull markets, and we've seen that over cycles again and again. If you see, what happened in from 2004 to 2007 bull market, you had a lot of PSUs, industrials. A lot of these stocks were the infra stocks were leading the bull market. What happened in the last decade, it was mainly financials, IT, consumer stocks that led the bull market. So, what you see is still shorter time frames, but I'm talking about longer time frames also. You've seen decades of valuation increasing in financials, valuation increasing in consumers, and all the money flow was going into those sectors. Now, what we're seeing that, especially in the last couple of years, you have new emergence of leaders, and some of those leaders are cap goods, industrials. And now, if you look at these sectors, they've done nothing for the last 10 years. You've had India has not seen capex cycle for the longest time, and we are seeing a revival of that. It's still early signs, but there's very clear revival. You've If you go back in 2008, you had an L&T and many of these infra stocks in everybody's name. Today, many of those companies are not even there, except an L&T. You've had IVRCL, which has gone away. You have had Gammon India, which is out. You've had many companies which are not even there. So, if someone who's going to build India, right? So it's going to be these companies, and the whole sector is getting got consolidated because you've not seen many infra companies come up and many capital goods companies come up. It's always been financials and consumer stocks where the money has flown. So I think that whole money will now start coming into some of the leading infra companies, cap goods companies, and we are seeing that tail continue, and we feel that some of these companies will build India.
There are a couple of dichotomous views around this, Varun. Um, and I'm talking about top down first before we come to the sector itself. That the most common adage is that a good stock at a bad price or a great stock at a bad price doesn't quite give you the best returns. Now, some of these high quality cap good names currently are at multiples which are certainly not low. But the flip side argument that some people make is that we are seeing that the earnings of these companies in a depressed earnings cycle, and typically in an up cycle which may last multiple years, the EBITDA growth and the eventual earnings growth is multiple times what it could be at the starting point. So help us understand, how are you thinking about this aspect when it comes to cap goods and maybe even infra?
Yes, I think very good question, and I would actually compare this to let's say if we go back maybe 8 years ago, and you saw many of these consumer companies which were probably not very expensive, but still expensive. You had companies like Jubilant Food, Nestle's of the world, and the where they were in the cycle is also very important. You had some of those companies which were not very well owned. Many of those consumer companies were called defensives or stable companies. They were not really called the growth companies. And I think something similar is happening in companies like cap goods, where on the face of it, they might look expensive, but the growth is still growth lies ahead of them. And I think one thing one needs to understand is that how owned it is, right? So many of these infra or cap goods stocks, especially the high quality ones, are not very overowned compared to the financial sector or the consumer sector, right? If you have to sell, let's say, 1% of HDFC Bank and put it in an ABB, I don't know what will happen to the stock, right? Just think about it, right? 8,000 crore moving to an ABB, there's no stock there because, one, there is no real supply, and because there's not, over the last decade, no one has bought some of these stocks. So I think elevated multiples could remain, especially if there is acceleration in growth. And I think that is the point one needs to focus on, that which of the companies which are well run, high quality, can grow at an accelerated pace.
Interesting. And Charandeep, I think this kind of ties in with the cancelim approach that you guys used to follow. I don't know if you still follow, but if you still do, then it kind of ties in with that, right? That stocks which are actually trading at premium multiples and highs are trading there for a reason, and you go to buy that.
Yeah, broadly, yes, Neeraj. I mean, we follow it, but we're not tied to any high or low multiple. It's a very unbiased approach. You have to look at the quality of the business. You have to look at the earnings acceleration, which has to be supernormal, and ahead of people's expectations. And you also have this supply angle that Varun talked about. Like what does well is what is typically under-owned. So stuff that's not easily supplied. Today look at the FIs are selling India, and they have been for a while now, for the last 12 to 18 months. What are they going to sell? It's what they really own, right? You want to pull $1 billion out of India, you're going to sell your HDFC Bank, your SBIs. You're not going to sell your ABBs. Especially when there's so much ownership, that becomes a headwind, not a tailwind for equity returns. And you need to be very cognizant of that at a time like today. And again, to reiterate what Varun said, what happened 10 to 12 years ago was a Hindustan lever came out of a shell, and it was trading at 30, 40 times earnings then, which was considered very expensive, if you remember. And everyone said, oh, really, this stuff doesn't work, it doesn't do well. There's under ownership there. And there was a lot of over ownership in the Larsen and Kubros, the ONGCs, the metals, the capex names, and cycle. Look at financial history. It's a history of cycles that keep taking turns. So you could be ahead and facing one of the most gigantic cycles India has seen in a long time.
Interesting. From a world perspective, if it prompted Ruchir Sharma, Charandeep, to say that oil is the new data, it kind of ties in with what you're saying about cap goods as well, right? In that it is under-owned, it is hated nearly, or was hated at least until 12 months ago. Earnings seem to be okay in the on the face of it. The starting multiples are actually a lot more sanguine.
Yeah.
Is Do things like these also excite you? Therefore,
Like what? Sorry,
like oil and gas, for example.
we look at anything. It's very hard to understand oil and gas. I must tell you, it's a very difficult sector, and whenever something's difficult to model, you have a higher probability of making money. I can tell you. You ask any analyst today that started his career after 2010 or 2008, ask him to build a model for a consumer company, and he'll build secular growth forever. Ask him to build a model of a cap goods company, and he'll say peak multiples, peak cycle. We're just not experienced enough in analyzing these companies. It's been a generation now that hasn't analyzed these companies, to be very honest with you, in depth. Most people who started their careers haven't seen what an upcycle can do. So I would say that even consumer is cyclical. There are very few staples companies, but when the whole sector starts getting painted with a secular brush, that's very dangerous for equity returns, because everything is cyclical. Be it by way of pricing or pricing pressure or too much competition, and you're seeing that right now. So one has to be very wary paying multiples over there. I wouldn't be wary paying multiples over here. To answer your question on oil and gas, we would look at it, but one is, I must say, there has to be some surprise in the earnings trajectory. And where can that come from? It's not going to typically come from volumes. That stuff comes from pricing and commodity pricing, and they're not good at forecasting that, to be honest with you.
Got it. Okay. Varun, let me kind of draw your attention to other themes. Let's say autos, for example. You guys gave this individual piece about UVs, but I want to start off with the macro question first, and then we'll come to UVs. Auto earnings seem to be trending well. After a really long hiatus, we're seeing some bit of traction back there. If rising rates are a worry for real estate, most people say that maybe not as much for autos, because it's a small, um, you know, effect on an overall piece as well. How are you thinking through when it comes to this theme?
Yeah, so the way we are looking at autos, if you just go back a couple of years ago, uh, you had this whole COVID era, and commodity inflation happened. Auto cycle peaked in about 18, 19. So you've not really seen an auto cycle for the longest time, and then COVID really destroyed the sector, and with rising inflation also hurt the sector. So you had a lot of tailwinds, lot of headwinds over the last 2 3 years, and now I think most of that is easing out. You had demand come back in a big way. You have uh, inflation cooling off. There was a massive issue of chip shortage, which really hurt the sector. That is also easing out. So I think it's we are seeing the reversal of what went wrong with autos. And I think that's turning out. So, one can say that the next couple of years will be great for the sector because there is demand. People have more disposable incomes, and coming into specifics of what we like is what you were talking about, right? We really think that the premium segment or the UVs and the SUVs is the segment that we like in the autos, because if you see, from 2014 we were just what 20% of the passenger vehicle was UVs. Now it's almost 50% and it's growing. So clearly, Indians want to buy better cars. There is availability of finance. They want more premium models. So if you're seeing the base entry level cars are not doing so well, and the premiumization in cars is really going on. So which really helps some of the players
By the way,
who are.
this chart from Girik Capital is very, very nice. We can just pull up that chart once and then I'll have a follow up question to that. UV volumes as a percentage of passenger vehicle volumes and just shows how sharp this uptick is. It's now a known secret, so nothing untoward about it, but still a pretty interesting data point out here. Now, the question, Varun, out here, and then the same one to Charandeep as well, broadly on autos, is how do you dissect this? Because there are established players within the listed space which are kind of leading the ranks when it comes to UVs. And then there are challengers who are now coming up and saying that, hey, we don't want to be left out of the game as well. How do you figure out um, where to bet on in order to play out this UV theme, if you will?
So yeah, I mean, there are not many options on the listed space because many of them are, if you look at companies like Maruti has a lot of entry level cars, so you can't really play it in isolation. But then there are companies like Mahindra and Mahindra where, like a couple of years ago, nobody valued the passenger vehicle business at all, right? And because, they had these Scorpios and Bolero, which was more like rural, and, it was steady, but not really, nobody really respected it for them. But then when Thar came, and then SUV 700, and then their whole thing about electric vehicles, and this entire focus in on SUV came, so it became a challenger, and we've seen some success from there. So I think that could be one. We are not really asking any of your viewers to buy it,
Yeah,
but
standard disclaimer, of course. Yeah.
I think one that could be a challenger because the market was not really expecting anything out of it for the longest time, because it was just considered as a tractor manufacturer. So one could so that's why we liked it, and we thought it could be an interesting bet.
Interesting. By the way, viewers, I mean, they might give the disclaimer as well, but let me tell you from our side as well, none of the things discussed out here would be recommendatory in nature. And please be mindful of the fact that any of the guests, not just Charandeep and Varun, but any of the guests who come and talk on the show might change their minds tomorrow itself and they'll not be able to communicate. So please, if you are trying to follow the cues on the base of the conversation that you're hearing out here, try and consult a financial advisor or do your own research before you try and take any actions out there. Charandeep and Varun, please feel free to give your disclaimers, but I think this is adequate enough. But feel free to come in with your disclaimers as and when you feel the need. The other aspect, Charandeep, that I want to bring you in is what the immediate tailwinds for autos, in that if the commodity prices have come off a little bit, does that add to the flavor? Because operational metrics will look much healthy, also considering the base effect of the operational metrics in 2022.
Yeah, so very near term, that's true. There will be margin tailwinds as you price through inflation. I think the real money is made, if you get steady volume growth for 2, 3 years and, there are no root shocks. So auto has been a litany of root shocks. The market hasn't grown at all in 10 years. I mean, if you look at the auto volume growth market, is dismal. And the story that was painted back then is India is such a great market. There's so much disposable income. People should buy more cars. Car is a very expensive beast to buy and to operate, both from a service, insurance, fuel cost point of view. The car market is thus very small, and one must not extrapolate massive numbers. But what we have seen, and which has taken us by surprise, is that it's the real premium car market that grows, right? So is there a way to play that premium, or call it SUV in this case, the premium car market, because that's much more price inelastic, you know? Um, people will people will think about putting those dollars down for an experience, right? So that are there auto dealerships that one could own that sell premium cars? There's a recently listed one. Um, so there are ways, but very few ways to play it. I think that one has to have secular volume growth for continued stock price appreciation, and that's not ever going to be easy. But you will probably have a higher chance of premium cars outselling the entry level cars as a continued trend, as there's more disposable income. So,
Got it. Got it. Thanks for that. Now, Charandeep, when I looked at again the presentation that I have access to, and please correct me if I'm wrong, but I saw that you probably have a 24 odd percent or 25% odd weightage to financials. A theme that, I mean, that weightage clearly shows you are underweight relative to the indices, but still 25% is no mean allocation. So where is it that you're present out there? Is it banks where people argue that the NIMs may actually have seen the peak quarter behind? Is it NBFCs where the argument is constructive, but only when rate increases stop? And as of now, the RBI still left the door open. Or is it the non-lending financials which have a lot of promise, but are consistently failing to deliver over the course of the last 12 to 24 months?
So if you are right, I think the financial sector is too vast now in India. If you look at financial sector, you have money center banks, private sector, money center banks, public sector, small private sector banks, old private sector banks, NBFCs, which could be asset financiers, NBFCs that could be on the unsecured side, and then you have life insurance, then you have general insurance, you have asset management, and then you have distribution, right? Wealth distribution. You've had a few recent listings there. So we own one of those plays. We see wealth distribution in India as a very profitable and secular play. We think that it's great to have exposure there from a long-term perspective. And if you can find a leading franchise, over there. So we own this company called 361, right, which is your whole IFL Wealth. We are big believers in the story. Again, standard disclaimer applies. Please do your own homework because we've done our homework. And I think, we like the long tail and the length of the tail and the lack of competition, lack of good quality listed players, very high quality institutional sponsorship from the likes of Girik Capital. I believe now, they're in now. Then on the other hand, we do own some of the banks. We have exposure to SBI, for example. We think there's a nice cycle underway there, and that could continue longer than people anticipate. It's a large profitable bank whose profitability is increasing. They've come out of a very long shell. We have a bank like an Axis Bank relative. We've eschewed the likes of ICICI and HDFC. Because again, there's an element of turnaround play in there. The metrics could catch up, and you're getting it at a much higher discount to peers. So that's the theme, really. We're not going for the standard index plays. We're trying to avoid those. We will be much more overweight than an index. If an index owns 2-3% of SBI, we could be higher. So we don't really benchmark ourselves like that. We find alpha in these, and that's why we own them. And that's really the thought process. The IRR should be hopefully much higher than what the index can deliver in these names.
Got it. To both of you, but Varun, I'll start this with you. The last couple of questions. One of them is on information technology. The sector has befuddled most experts. It's played contrarian a number of times. People have tried to give a verdict on it. How are you thinking about IT services and maybe even the platform names, if you will?
Sure. So, the way we look at it, we used to own it just out of the COVID cycle, especially because many of those sectors came out of nowhere, and a lot of tailwinds also because cost went down substantially, the demand went up, and I think if you see what really happened in IT sector, you had earnings acceleration. And as the philosophy of Girik is we like to follow earnings acceleration and sustainability of that earnings acceleration. So what you saw in IT, you had immediate earning acceleration, a lot of demand came, and also cost went down, and then that peaked, and that's what we that's why we went out of IT, and we don't really own much of IT because that really peaked. Great companies, good industry, very long, profit, very high profit pools. But when earnings acceleration slows down and when that peaks, your multiples contract. So what we really believe is that the multiple expansion is is directly related to earnings acceleration, and the multiple contraction is also directly related to earnings detraction. So
Deceleration, yeah, sure.
deceleration. So that is what we saw in IT. Your earnings actually did stopped accelerating at that pace. Margins peaked, and now it probably has come to reasonable levels. So now I think it probably comes back how it used to trade in the past. Also, it's also linked to what happens in the US, right? So what you saw, some of the IT name came back because your Nasdaq started performing. Because a lot of money flow comes, and it's linked to some of the IT names in the US, because there is also relative valuation that one needs to see, right? How the names in the US are trading compared to some of the names in India, you know, in that sense. Coming to your platform names, of course, they all listed with a lot of premium, and I think we really believe that the overvaluation is out. But one thing what market is really not rewarding yet is what's going to happen 1 year forward, 2 year forward, or 5 year forward, right? It's very clear that markets want to now see clear visibility of cash flows, clear visibility in earnings, uh, because you are not getting that unlimited supply of capital anymore. Earlier you had, these guys could raise money at will. They could keep bleeding money, and it was okay because you had stability. That's clearly out of the picture now. So one needs to really bet on companies which can turn profitable sooner than later.
Okay, that's interesting. And let's see if indeed one or two of those which have cited some road to profitability get rewarded duly for the moves that they are making. But this was special in more ways than one. Charandeep, Varun, thank you so much for taking the time out. I have lots of questions, but we've taken enough time off on this show already with the two of you. So we'll let it be on this note. And thanks for joining us today on Talking Point.
Thank you. Thanks, Neeraj.
Thank you, Neeraj. Thank you so
And
much.
viewers, thanks for tuning in.